July's core PCE inflation report landed at 3.3%. That number might look harmless on its own, but the Federal Reserve has drawn a strict line in the sand at 2%. Mathematically, 3.3 is 1.3 percentage points above that mandate. That means current inflation is running roughly 65% higher than the central bank's stated objective. The Federal Reserve has made it clear that a 2% annual rate is the only level consistent with their price stability mandate. They are obligated to push this number down. A declining rate of inflation does not guarantee that interest rates will immediately follow. Assuming the era of easy money is returning right now is a dangerous bet for any portfolio. Meanwhile, equities are thriving. The S&P 500 has climbed roughly 12% this year, keeping the broader market sitting comfortably near record territory. Second quarter corporate profits surged 33.5% year-over-year, marking the strongest pace of earnings growth since 2021. Yet, the consumer data is fracturing. Personal spending edged up by only 0.2% in July, as shoppers become highly selective with their remaining disposable income. Look deeper into the macroeconomic picture, and the momentum fades further. Second quarter annualized GDP growth has slowed significantly to just 1.5%. The broader economy is flashing late-cycle warning signs, but equity valuations reflect a market priced for a flawless, uninterrupted boom. The stock market's current trajectory relies on growth targets that current GDP and spending levels have yet to prove. Central bank policy dictates asset prices. Starting at the Federal Reserve, it feeds the bond market. Holding rates between 3.50 and 3.75% pushes the 10-year Treasury to 4.64%. This acts as gravity, forcing stocks to justify their inherent risk. Mathematically, as interest rates climb, the present-day value of a company's future cash flows decreases. Future dollars become less valuable today. Elevated Treasury yields strip away the market's popularity contest. Investing becomes a mathematical test of valuation. We can see this test happening right now in the AI sector, led by Jensen Huang and NVIDIA. The company boasts a $5.16 trillion market cap, trading at roughly 32 times its trailing earnings. Competitors offer a different thesis. Under Lisa Su, AMD presents an alternative bet, capturing enough of the data center market to close the infrastructure gap. Equity prices do not reward a company simply for being profitable. They only reward companies that can outpace the expectations already embedded in their stock price. For the AI sector, those expectations are high, with analysts pricing in quarterly revenue targets of $92 billion. If a high-growth company misses those targets slightly, it faces multiple compression. Earnings expectations drop, and the premium valuation multiple collapses at the same time. Buying a profitable tech giant at the wrong price carries downside risk. The current stock price requires a flawless macroeconomic future. AI development is a physical undertaking, requiring heavy investment in tangible infrastructure. Data centers require vast electricity, specialized processors, cooling systems, and construction materials. All of this demands upfront capital before any profit is generated. Elevated interest rates break this expansion. Rising borrowing costs make financing massive data center projects significantly more burdensome for corporate balance sheets. This link means the tech rally is sensitive to shifts in interest rates. If policy remains restrictive, the cost of building out AI capacity may eventually slow the momentum of the market leader. The market is facing a difficult scenario, sticky 3.3% inflation colliding with GDP growth that has slowed to 1.5%. This environment tests every business model. Banks can earn higher interest income on their assets, but they face risks if a slowing economy causes borrowers to default on their loans. High-yield dividend stocks look appealing, but a high payout is worthless if declining earnings force the company to cut the dividend entirely. High-debt small caps face immediate pressure, as they must manage refinancing costs in a rate environment that stays higher for longer. True defense requires a strict filter. Prioritize companies that possess strong free cash flow, low debt burdens, and genuine pricing power. Persistent inflation doesn't mean you should sell everything. It means you must ruthlessly stress test the balance sheets of every company you own. Stop reacting blindly to isolated macroeconomic headlines or single inflation reports. This causal chain illustrates the logic. Inflation dictates the Fed dictates rates dictate borrowing costs, Borrowing dictates growth. Growth dictates earnings, and earnings dictate valuation. The true danger lies at the end. Can earnings grow faster than the rising cost of capital? Financial risk is often found in the gap between market expectations and economic reality. Paying a premium for a stock requires the underlying